right, everybody, welcome back to another episode of the Study Wealth podcast. We're going to talk about growth investing today, and I've got Brad Newman here. He is the director of market strategy at Alger. They are growth investors. You may have seen them. I think I just saw one of your colleagues on TV just the other day, if I'm not mistaken. Brad, how are you? Thanks for being here.
Thanks for having me. Great to be here.
So obviously growth is something that everyone talks about all day, every day, particularly for the past 10 to 15 years. When you and I spoke beforehand and kind of discussed what we could talk about that's interesting to our audience and relevant to the current environment, you brought about a couple of points that I would say when you talk about growth investing that I have not heard a lot of people talk about. And so I'm just going to give you an opening volley here. Obviously you guys as growth investors, what is your sort of base case for growth as you kind of look forward from here on?
So when you think about growth investing, growth stocks are really the drivers of change. And we believe the change is accelerating. So this is, in our view, the most innovative time in history. If you think about technologies and how they diffuse through society in the past, you have now much faster progression of new technologies. So the washing machine and cable TV took several decades to reach 50% of U.S. households in the early and mid 20th century. The PC took 25 years in the 70s, and the internet and social media more recently did it in 14 and 9 years respectively. Tablets even quicker in 7 years. And we think large language models will reach 50% penetration in just a few years. And if you count Gemini, they pretty much already have at Google. So the speed of innovation is increasing, and that's causing disruption to accelerate much faster. So the Microsoft products that we all know and love, like Microsoft Windows and Office, took about a quarter century to reach 1 billion users. Google search took about 12 years. Facebook took 9, and more recently, TikTok took 5 years. So disruption and innovation is happening much faster than ever before. And because growth stocks are the drivers of that change, that means that their growth is speeding up. Whereas on the other side of this, value stocks, which are, when you buy a value stock, you're buying it cheap and you're hoping it's going to become less cheap. You're hoping it's cheap for a temporary reason. A lot of the value stocks, if change is accelerating, they become value traps. So when you think about coal stocks or newspaper stocks, radio, brick and mortar, retail, all of those stocks, all those industries seem cheap at one point. But in reality, change caused them to have their earnings decline over time, and they became kind of melting ice cubes, or what we call value traps. So the faster that change accelerates, the more of a tailwind it is for growth investing in our view, and the more of a headwind it is for value investing. That's the biggest structural issue. We can get into the second structural issue if you want as well, which I think has to do with intangible assets and the new economy.
Yeah, actually, I really want to talk about that one because that's what I was alluding to before that I thought was very interesting. I did take the liberty of putting up a chart that you were kind enough to send me, and this is kind of where you see, the years of market entry to 50% penetration as you just walked us through. I guess one question that I always get from clients, and a lot of our clients are not necessarily professional investors, although there's plenty of those as well, but they kind of come across ideas from their friends, from TV, from wherever. So one of the questions that I always get is, what is growth? Like, is it specifically focusing on an industry? And, a lot of people, of course, associate growth essentially with technology. Would you use those words interchangeably, or do you believe there's growth areas elsewhere that's investable and comparable to technology growth investing? I mean, obviously your other stories, but just kind of wondering how you kind of parse that.
Well, I don't know if you were leading me to this, but I think there's a big problem in the definition, actually. So we could talk about how in traditional finance and investing and the benchmark companies define growth and value, because that is actually the second structural issue of why I think growth has outperformed for the past 20 years. Or we could talk about how we would define it. I mean, so Alger invests in change, and we believe that change begets growth. I mean, there's winners and losers from change. The winners grow, and the losers obviously stagnate or shrink. So, in general, I think growth investing are companies with higher expectations, so a little higher valuations. Some might call them longer duration type of assets, where more of the value of the company is in the out years, further in the future. And value stocks are typically shorter duration, more current cash flows, and lower expectations, and generally cheaper. So that's how I would define it for your listeners broadly. Now, unfortunately, there's a few companies, or really one company, that gets to really define growth and value, and that's FTSE Russell. And Russell has they have trillions of dollars indexed to and invested in the style indices that many individual investors invest in, or even if you're not directly invested in it, you're probably invested in some kind of fund or that has a benchmark to these Russell style indices. And they have pretty simple formula. It's 3 variables that define growth versus value. The biggest one, though, which is 50% of the formula, is based on price to book value. So essentially, stocks with low price to book value are value stocks, and stocks with higher price to book value are growth stocks. Now, book value is simply net assets. It's assets minus liabilities. So you're taking the market capitalization of the stock, that's the price, divided by the net assets less liabilities, or book value. And that is a very powerful concept. It was one of the first factors introduced in the early 90s. It's a Nobel Prize winning type of insight, that stocks that are cheap relative to their net assets are probably cheap relative to their earnings power. So you think about maybe an auto manufacturer, say, is down on its luck, and it's, for whatever reason, it's not selling as many cars as it used to. Maybe the economy that it's in is in recession, or its style of car is not selling well. So it's not cheap on earnings. The earnings have declined. It may not be cheap on sales, but nevertheless, it has this steel in the ground that can produce a certain amount of automobiles. And so its stock prices decline, presumably in this case, relative to its net asset value. And so investors can look at that and they can say, well, the net assets of this company, the factory that can churn out X amount of cars, 10,000, 100,000 cars. And so ultimately, this stock may be cheap when that asset becomes productive again. That's a great concept, and it works generally, except for structurally over the past several decades. And there's a chart of this somewhere in there, Serge. If you look for it, the economy has been investing over the last 40 years much more in intangible assets than tangible assets. So tangible assets are things like property, plant, and equipment. Intangible assets are things like brands, investment in software, code, new drug development, those kinds of things, even human resource training. So as you can see in this chart, the intangible investment has soared over the past 40, 50 years, and the tangible investment has declined, and this is government data. Now, the issue here is that intangible assets are not on the balance sheet. They're expensed, so they hurt the income statement much more, and they're missing from the balance sheet. So if you think about a fantastic asset like Google's search engine algorithm, it's completely missing from the balance sheet. So the greatest companies, say, of the 70s and 80s, you think of big auto manufacturers or retailers, their assets were on the balance sheet. They had a lot of inventory, they had a lot of stores, they had a lot of factories, they had actual cars, what have you. So the book value is very accurate. Today, with Google's search engine algorithm not being on its balance sheet at all, the balance sheet is completely misstated. And by the way, when they were developing that, it was a huge drag on earnings, because instead of being capitalized, it was expensed. So I'll give you an example. say you had two banks, and one bank decides that it wants to attract customers by building a lot of branches because people go to their local branch. So it spends $100 million on bank branches. And those bank branches, the $100 million goes onto the balance sheet. Maybe it has, I'm making this up, a 5-year useful life. So every year they recognize 20% of that $100 million as depreciation expense on the income statement. So you have a $100 million asset, $20 million in expenses each year. Pretty simple. Now you have a different bank, and this bank says, we're not going to invest in brick and mortar branches. We're going to be an online bank. It's going to be much more efficient. Our cost structure is going to be lower, and we're just going to develop software that is going to delight users and attract a lot of users. So they spend $100 million not on bank branches, but on software they develop. The catch here is that software is expensed, not capitalized, meaning $100 million hits the income statement and expense as they develop it, not the $20 million from the bank branches. Instead of having $100 million of an asset on the balance sheet, they have zero because it's all expensed. So you have dramatically different balance sheets, dramatically different income statements. And what it's meant is that companies that used to be value stocks and actually potentially have low expectations and cheap relative to their earnings power, have low price to book value, are now simply companies that have more tangible based business models that are less innovative. And so now instead of value stocks being cheap and out of favor and growth stocks being kind of more having much higher expectations, value stocks today are actually less innovative, more tangible based businesses, and growth stocks are more highly innovative and more intangible based businesses. And in fact, there's a researcher named Baruch Lev who adjusted price to book value, which has been a terribly performing factor. And we have this here somewhere in the chart search. He adjusted the price to book value and capitalized these intangible assets. And what he found was the lower price to book value factor started working again after having a miserable experience. Price to book value as a factor outperformed low price to book value outperformed on a 10-year rolling basis just about all of the time. You can see this on the left chart for decades and decades up until 2013, 2014. And since 2014, it's underperformed very consistently. And that shows that price to book value is broken. But again, if you capitalize intangible assets, you can turn that around. So it shows that something's wrong with the accounting system, and shows that something's wrong with growth and value. And until this is rectified, growth stocks essentially have this big advantage over value stocks because they're much more innovative. And you can see in the chart on the right that they've dramatically outperformed for the last 20 years, which a lot of academics thought would be impossible or extremely unlikely.
Well, it's fascinating. In fact, one of the pushbacks that you always get from sort of a very rudimentary sort of moldable look at a company is, it's too expensive. It's trading at X times sales, right, or X times earnings if there are earnings, right? Could you make the argument in this case? Then let's take the Google one, where you're saying the Google algorithm is not represented on the balance sheet. Do you feel like then it might be showing up more in it because of that? Some investors will look at it as, okay, maybe it just deserves a higher multiple. Is that lack of accounting represented in the multiple somehow being given more leeway there?
Totally. So this is a big problem I think for asset allocation and for style classification. So growth stocks. So everything I've told you about accounting, all the problems, that just affects what we call accrual accounting. So the income statement and the balance sheet. The cash flow statement in those two bank examples I gave you, their bank accounts are the exact same, right? They both spent $100 million. They both have $100 million less, and that's the cash flow. So we can look at something called free cash flow conversion, which is free cash flow relative to net income. So if I'm telling you the net income is distorted and the free cash flow is the actual picture, then free cash flow to net income should tell you the story. And so what you find for growth stocks is free cash flow to net income is about 100%. Free cash flow net income, however, value stocks is about 75%. So obviously, an investor would want to pay, all else equal, more for $1 of earnings for a growth stock than for a value stock, because you're getting 100 cents on the dollar in free cash flow versus 75 cents on the dollar in cash flow for a value stock. This also has dramatic implications for, I think, for asset allocation, trillions of dollars of an issue, because most people think about the stock market in terms of price to earnings multiple over time. So, for example, the historical price to earnings multiple is, between 16 and 17 times, and right now it's 22 times earnings. So that seems extremely expensive, right? Well, the difference is that free cash flow relative to earnings today is much, much higher because of all the issues we've talked about, and the types of companies that are in the index, than it was 30, 40 years ago when we're talking about that average. So today, I'd argue that earnings should be valued much higher. In fact, I was quoted in a Bloomberg article as saying that if you capitalized these intangible assets, which are, in my view, clearly assets, even though the Financial Accounting Standards Board doesn't recognize them as such, the earnings for the S&P 500 would be more than 10% higher. So really, you should take, to compare to history, more than a couple of multiple points off the price to earnings multiple to be able to compare it to history. And yes, it means that growth stocks should have much higher multiples than value stocks. Industries like software should have much higher multiples than, say, old economy, industrial, and auto manufacturers, those types of companies. So yeah, it's a big issue for traditional accounting metrics.
Yep. No, it's, again, I think, and this is really to me, this is the big takeaway. I think this is a huge thing that people should think about now. I will also say, from my perspective, obviously I'm not giving advice here. This is purely sort of an educational exercise in the podcast. This does also not mean that one should now go out and buy any stock that's trading at 500 times earnings just because it doesn't matter anymore. There's a lot of volatility that can happen in this stuff, and obviously this, but I'm just saying this for our audience as well. So this does not mean that it's now okay to buy any crazy high multiple stock. But I would say, and I think we might be able to put a bow around it here, and tell me if there's another chart that you'd like us to go through to kind of wrap all this up. But I would argue that if Google's algorithm isn't on the balance sheet and reflected more in a multiple, I mean, I can only imagine what that would be like on, let's say, an AI application that will be, at some point come to fruition. You could imagine, because we don't even know, we have no idea what the application, what the depth of sort of capacity will be on AI stuff, right? Not talking about the brick and mortar stuff, the stuff we're laying out right now, the sort of the infrastructure with NVIDIA, but what can we do with it? I mean, I would imagine we could see some crazy PEs or whatever that people are going to just scoff at, but really they're kind of almost hard to value.
Right. So, we were talking, so we've made 2 points about growth versus value. One of them was the accelerating growth, and one of them was the accounting issues. So on the AI, obviously, if you're investing, if there's an AI company, a lot of that investment will weigh down the earnings in the near term. And so the accounting issue will play some role because the earnings will be, zero, low or negative, and look like it's very hard to value, even though they've been creating a huge asset. But maybe the bigger issue with AI is the growth rates. So if you think about Moore's law, which I think your listeners will be familiar with, it's simply stated the number of transistors on a chip doubles every couple of years. It was created by Gordon Moore, who worked at Intel for most of his career. And, he wrote this, he wrote that in 1965. At the time, there had only been a few doublings. But now, and there's only, less than 100 transistors on a chip at the time. Today, if you carry a modern iPhone, you've got 15 billion transistors or so in your phone, in your pocket. If you think about more AI, it's growing actually much faster than Moore's law, which has ushered in a tremendous amount of value for all of us in our personal lives and hopefully our portfolios. But AI is the training, which is how much compute is used in the AI models. That's very well correlated to how smart the AI models are. And that training is doubling every 6 months, not every 24 months like Moore's law. So to put that in perspective for you, if you had a 6-inch plant growing at Moore's law over a decade, it'd be 16 feet. If you had a 6-inch plant growing at the speed of AI, doubling every 6 months, it would reach outer space in a decade.
Yeah.
That's the power of this very fast compounding, and that's why I think the future will be very good from a technological standpoint, and I think AI will continue to amaze us. It's why the progress is really so fantastic, even on a month-to-month basis.
Yeah. Yeah. No, it is. And honestly, I think the thought process here of being able to get around some of those multiples that, everyone that's a value investor will kind of, sort of snicker at. I think there is a lot of justification for that. Now, again, I will say there will be winners and losers. There'll be ones where that is certainly not applicable to those high multiples because the business doesn't come to fruition. But I think it's an extremely important thing to think about from a portfolio allocation perspective as well. Brad, this has been super, super helpful. And again, I really don't. I've honestly not heard that argument articulated, certainly not as well as you have. Any final thoughts?
Just that the speed of innovation is moving very quickly, and you really need to have a view as to how the technology is unfolding, or if you don't, or if that's too difficult for a retail investor, then I think it's important to be invested in a manager that understands innovation and has a long history in it. And of course, Alger's been doing it for over 60 years, so we feel like we're pretty good at it. But I think it's important to be on the cutting edge of innovation.
Absolutely. Alger.com is where you guys can find Brad's company, I should say. Brad, thank you so much for this insight. I really appreciate your time and the effort and I think the visual aid as well. Thanks so much. And for all of you guys listening, thanks so much. We'll see you guys in the next episode of the Steady Wealth Podcast.